All right, good morning and welcome to the OptionPit special Saturday class on weekly options. We've got a lot of great stuff lined up for you. I've looked through Andrew's presentation. It's freaking sweet. And then Andrew looked through mine and he seems to like it as well. So hopefully we're going to make the best of the next 3.5, 4 hours or so. If you have questions about anything or you want to know anything, my email is mark@optionpit.com. Andrew's email is andrew@optionpit.com. At the end of the class, I'm going to make a special offer on our silver course. You can go to, if you want to preview it, it's at www.optionpit.com/silver special. So you can check that all out. All right. On that note, I will hand things off to my good friend Andrew Giovinazzi, and I'll let him begin. Here you go, Andrew.
Okie dokie. Mark, I don't know. You're seeing all these notes. I'm just about the webinar. Anyway, I figure you got it taken care of. All right. All righty. All right, everybody, let's get going. My name is Andrew Giovinazzi. I'm the Chief Operating Officer of OptionPit.com, and we're going to talk about the weeklies in various guises today. Mostly what I'm going to do is I'm going to talk about how we use time spreads in the weeklies at OptionPit. Mostly how we look at them in our chat rooms. In our chat room, how we'll put stuff on for in our strategy letter. How I just buy time spreads, trying to what I would call, like, euphemistically trying to buy inexpensive options. So, and the idea is, and what we'll go through is all of the interesting ways to do that, right? Or the things that get my interest in a time spread, because there's kind of some moving parts to them. But specifically, we're going to talk about the weeklies. So, hold on here. I'm going to do some background muting. All righty. All right, so first off, why you want to use the weeklies in the first place. Okay, so we'll go over that. I think weeklies as a time spread are different than using any other option like ordinary options or leaps or anything like that. So once you change the term in an option, timed expiration is part of the option model, right? So it's a different option. Like, weeklies are going to behave a little differently than other options. Okay, the second part is what I think will probably be the most useful part for some of you that are new, is using weeklies as a sentiment indicator, right? Because you want to at least read the information the market's giving you. So while I'm not a technical analysis person per se, I am always interested in how the market prices volatility, because that, to me, as a market maker, was always the best. It was the best indicator of sentiment, what everybody was thinking. Then we'll go through what makes a good weekly time spread. Some of the things, obviously, a good time spread is one that's going to make you money, so you want certain things in your favor before you start. And that's part of kind of the conditional trading we look at here. Using the term structure to your advantage. This is mostly what we'll be talking about. And then choosing the right one. Like, trying to pick what is going to work for you to get done what you want to get done. And then lastly here, we'll just look at risk in short weekly premium trades. Okay. Risk, how to manage it, things of that nature. Again, if you have questions, put them in, and if I look at them, and if I think we're going to answer them in the kind of the meat of the class, I'll just let you know that. Okay. So the first thing is let's talk about what a time spread is and what a time spread isn't. So they're also known as calendars from an introductory point of view. So if you look down here, whoa, malware. That's actually to protect. Whew, The malware is protecting me, or whatever. I'll scan it after this. Anyway, take a look at what our time spread is. So first off, in general, what we mean, we're only going to talk about one specific type, where you buy the back month option and sell the front month option. Okay, that's the most important, number one. So right away when you do that, what are you looking at? Right, you're looking for a change in relationship between the two options. Okay? So what you want to figure out is, once you spread any option, one against the other, you want to figure out what are the conditions that are going to make the two options come together, meaning you want your long option to gain in value and your short option to lose value. So what are the things that are going to make that happen? Okay, so that's what we'll go over and discuss today, but there are certain characteristics of a time spread, weekly time spread, but it's germane to all time spreads. So if we look at our risk chart here, okay, we're starting, as you put the position on, you start at the red line, and every day that goes by, yellow, green, all the way up to the peak, essentially, which is right at the strike. So in our case here, we bought the 440. This is a weekly trade that we looked at on Friday morning in our chat room. And basically, as the day went on, it kind of matured very well as a trade. So the idea is, when you're looking for something like this, this is, from the red line to the purple line, is your full, basically what we'll just call your holding to term. So everything sort of happens, your position will start to mature where you slowly gain dollars, right? So in this case, you put the position on, and by the end, if everything goes perfectly, it lands right at the strike and you make $1,400. Now, the first thing I tell you is that rarely does everything go perfectly. So what you're shooting for when you put on a time spread is some fraction of this. So the idea is, I'm buying the 440s and I'm selling the 440s. Right, so Rob, so we'll talk about that. That's basically what our whole class is today. But it was an excellent question. So what we have is, there's just a couple of conditions. One is, obviously, you make money as long as you stay in a range. So that's number one. Okay, so that's a time spread characteristic. Number two is, it has a mild delta. You're short a little gamma. So basically, what we call a time spread is a short gamma position. You just don't want it to move a lot. All right? But that's one of the keys to the position, is you're not looking for a lot of underlying movement, right? So if you ever put on a time spread, oh, the underlying was right around 455, 450. Where can I see this risk chart? I have only toss. Oh, okay. If you have toss, boop, okay. Put your time spread in. Here's the same time spread and toss. I conveniently have it ready for you, right? Amazon was trading right around 446 when we put this on, Wes. Okay? So you put your time spread in here, okay, and this will give you, again, a similar position. This white line is, the P&L now, and then moving to the peak. Okay? So one of the key things about this, hopefully that answered your question, Kuba, is, right, you have a current position at around 445 where the stock is, and you have a little bit of movement and a little bit of movement up and down. Okay, so that's what we're trying to get to there with this particular one. So the thing is, we're going to go through kind of the why and what we expect to get out of it. Okay, so the next thing we're looking at. So terminology-wise, spreads are, all time spreads are calendar spreads. Correct, Teo. Teo or Theo. Interchangeable. So what we're looking here is, right now the way this position is pricing, Okay, it's giving us about $90 a day in decay. That's our theta number. You buy May 2 and sell May 1. How do you pick the strikes? I had to restart my computer. Doug, we just started. I haven't even gone into strike picking yet. That's how we'll discuss this whole thing today. Okie doke. No problem. All I want to do is, can you show everyone, so everybody is not seeing the questions? What I do is I'll make sure, okay, what I'll do is I'll read them out first. All right. So some of the questions were, what is a calendar and a time spread? Is that the same terminology? The next one was, you're buying May 2 and selling May 1. How do you pick the strikes? Okay. For some reason, I don't know why, go to webinar. I don't think it lets you do that for some reason. Go to training does. So all I'm trying to set up with is, this is what a time spread looks like when you put one on. And we'll go through now kind of the details of it, especially in the weeklies. Okay. But I'm just setting up your delta profile. This one's a little long. This one is a little short when we set it up at 0 short 13 deltas. You're a little short gamma. You're collecting $90 worth of theta. And you have a positive, basically, your long volatility. He's asking, what platform is that? This is LiveVol. And yes, the recording will be available. I will make sure Mark posts it. We will send out all the information. Okay, so the important thing about the weeklies is that they are the options that reflect market sentiment in the most immediate way. So if you're trying to figure out what the attitude essentially of the market is, the weeklies are going to tell you the story. And the changes in implied volatility of the weeklies are going to give you basically a movie on how the market expects things to play out. So how we do is the differences in the IV are what we use to help figure out what the story is going to be. Okay, so a key thing with a time spread is, okay, you have to have a story for the underlying, meaning how's it moving, where's it going to some degree, is it moving fast or slow? This is all stuff we're going to cover, but you want to see how the market is describing that movement already. Okay? So how we do that is, right, the story is in the term structure for the options. Oh, and by the way, once we're at about 45 minutes in, I'll give you a few minute break, and then we'll reconvene and after a couple minutes, then we'll reconvene for another 45, okay? So one of the key things is usually each weekly term has a different implied vol, okay? Meaning that the market is pricing different weeks at different prices. They're essentially saying, I think this week's going to be this volatile. I think next week's going to be that volatile. I think 2 weeks from now is going to be volatile. A month from now is going to be this volatile. Right? And what we call those are essentially the sigmas, meaning that's sort of the average volatility for the term, for whatever the week is. Okay? But the market is giving you different information per term. Now remember a couple of things on what generates volatility per term. If I had to say who generates the volatility number for a term, what would you tell me? Who's deciding what the volatility for next week's options are going to be? Is it me? Wes is saying the market maker. Pry is saying day traders. That's Prawl, hopefully if I can read. The market. Eric is saying the market. Okay. It's paper, right? Everybody that buys or sells options determines where implied volatility is going to be. Okay? All the market makers do is respond to supply and demand. Okay, so you have to think about it from their shoes. One of the easiest ways to understand how markets work is you have to sit in somebody else's shoes. Okay, sit in the market maker's shoes. So if paper, and when I say paper, that means institutions, retail, anybody that's not a market maker is coming in and buying a bunch of options, what would you automatically do? Right? You'd raise the price. Everybody's saying raise the price. If somebody comes in and starts dumping calls on you, sell, 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 what are you going to do? Right? You're going to lower the price. Not only that, Eric, widen the market. That's definitely one thing. That was a good answer. Okay? Put them in the right? But you're going to keep lowering them until what? Exactly, the buyers come back in. You're going to lower them until they stop selling. Okay? That's how supply and demand of equity works. All my job was as a market maker was try to balance supply and demand. Okay? And how Mark and I developed the teaching in OptionPit was basically how we had to manage a bunch of positions, you know, front spreads, back spreads, and convert them into something that is more retail oriented. But the important thing with term structure in, it's responding to you, right? So when you're looking at it, you want to see what everybody else is thinking, right? What is the market giving you now for information? So what I'll say is, when we start looking at this, the greater disparity in the weekly term IV, the more certain the market is about a particular direction. Meaning, are we really moving or are we staying kind of slow? Okay. So what you want to do is, and there's several ways to look at sigma, okay, is you're trying to glean the information that all the participants are giving you. So when I'm looking at this, okay, sigma is just another word for average volatility per term. Okay, so April 24th, you have 59.33 vol. Okay, note down here, it dropped 123 points. Okay, this is the day that Amazon reported earnings, and this was Friday. Where to find sigma and TOS, Prowl is asking. You find it right here. Go to simulated trades, and all your sigmas are going to be up here in the right-hand corner. Okay, you can also find it. It's a little uglier, but in the product depth. Right, you can pretty much only use 2 strikes at once. So you can see where the volatilities are per strike. Okay, right here. Okay, it is not the same as open interest. Okay, it is not the same as open interest. Do you guys see this right here? Because the difference is, right, and the Prowl's asking, is it the same in open interest? And my answer is no, because, right, all the terms are linked. So if there is massive open interest, let's say in the April 24 strike, right, do you think that's going to affect how liquidity providers price the May 01 term? Absolutely, right? All of the thing with the weeklies, since it's a relatively new product, I mean, to the marketplace, it's a couple years old, right? Okay. All these are all linked together. The liquidity in the April 24th affects the liquidity in the May 1st, which affects the liquidity in the May 8th, which affects, and so on and so forth. So the idea is you want to be able to see what the market is predicting. Right? So here you're seeing a 59 volatility, which is pretty high, but it's also expiring that day. Right? volatility for one day doesn't really make a whole lot of difference. It's more like a guess on where the stock is going to pin. Okay, and whatever that number is, it could be $2 or $3, it gets a volatility number. Okay, once you kind of discount the front month, you see a pretty clear pattern here of 27.37, 26.31, 25.66, 25. You notice how the volatility is kind of slightly decreasing here through the weeklies, correct? Does everybody see that, how each sigma number, again, average volatility is a little less per strike, per term? Brad J is saying where the stock is going to pin. That's the closing strike price on expiry. That is correct. His question is where the stock is going to pin. Can you pull up sigma on Apple on toss because it hasn't reported yet? I'll tell you what, can I do that at the end? Because I'm going to do some live stuff at the end, Dave. But you're going to see something very familiar. Do you need to be familiar with the horse? Yes, you do. So we're going to cover that. Okay. Wes's question was, do you need to be familiar with historical or average vol? Yes, you do. If you want to trade this in a certain way, you do. Okay. Next question. Sigma changes about 1 from 27 to 26, but sigma change. Okay. So what this is here in live vol, what this is telling you is this is how much the volatility dropped in one day. This is how much the sigma, the implied volatility average, dropped in one day. Okay. So you're looking at two different things here. You're looking at how each sigma dropped per day. So again, sigma average implied vol for the term. Okay, so for all the May 1 options, the average vol at the pricing in real time is 27.37%. Okay. Same thing with the May 8 term. Average vol for the term was 26.31. So live vol takes, and every sigma is slightly different. Right, so the thing I would recommend is you keep the same platform. That way, all the volatilities will be consistent. Right? So sigma can change. It can be different in two ways. Right, you've got term to term, and each term can drop individually. Right, so that's kind of a part of the key thing. Okay, these vols can move independently of each other. They're related, but they can move independently, as you can see, and they can be priced differently. Is the sigma drop valued? That's in volatility points. It's not in dollars. That's in pure percentage. So you went from so the April 24 strike, so what he's asking is the sigma drop here valued in dollars or percentages. So what this is sigma dropped, the volatility dropped from basically 182 points down to 59.31, 59.33. We haven't, what we'll do here at the end, Dave, is we will convert vol to dollars, right? That's what you use Vega for. Okay. So just looking at how the market prices this stuff, right? You're trying to get a sense of something. All we've done here is I'm trying to lay out volatilities and prices for what we're seeing now. We haven't tried to analyze anything. All we've done is this is how the market prices weeklies. Okay. But the idea here is it's the pattern of how these vols relate. That's what's important. Okay. So if this is all new to you, you'd be like, holy crap. Right? So this is a key thing. I'm trying to make it as simple as possible. If the volatility pattern is upsloping, right? Do you have kids where you have loud, quiet books or yummy, yucky books? Or I don't know if you guys have little tiny kids, but anyway. So what I try to do is come up with something to describe that similar thing. If volatility in the near term, the sigma is higher than the volatility in the back, the expectation, exactly, the expectation is for much more movement. So the steeper this vol pattern is, the more movement the market is expecting. Brad said, Everybody poops is my favorite. Okay. Now, when the market is down sloping, right? So this gray line is just, that's if every term is the same. That gray line is just like, there isn't a quiet expectation, there isn't a loud expectation. It's mostly just, we're not expecting less movement, we're not expecting more movement, we're just kind of expecting more of the same. Okay? Right? Now in the weeklies, once that front month gets severely downward sloping, right, the expectation is we're not going to have a lot of movement at all. Meaning we're going to have relatively low realized vol. Question: do the vols change in real time or is it daily? Vols change in real time, Dave. Essentially this: anytime you buy or sell an option, or paper buys and sell an option, it's going to reflect in the price. If it's enough to move the market, it will move the implied vol. If there is a sell-off and VIX spikes, will the vols spike as well? Yes. So if you're looking at this chart and there's a sell-off, do you think the volatility pattern is going to see green line or red line? I'm reading left to right. I'm reading the exact same way that we read here, right? All I did was I took these numbers, right, from left to right, and I put them into a chart. So the near term is on the left, far term is on the right. That's a good question. He was asking, are you reading left to right? So if you wake up tomorrow, or we go into Monday and we're down 4%, what are you going to see? You think the term structure is going to be green or red? Dave says green. Anybody else? Okay, this is where you all have to answer. If the market tanks on Monday, are we going to see green or red? Sarab says red. William says green, green, green. Brad says green. Thank you. Green. Sarab, you're the only one that said red and you're wrong. Well, the worst part is I tried to use terminology, market is quiet, and if the market tanks, that is anything but quiet. Oh, it's okay. If you're drinking wine, that's all right. You wouldn't be the first person to drink in our webinars, by the way. I don't, but I do know that people do. Oh, it's Saturday night. I forgot. Well, I hope the wine is good. Anyway, so once you see a term structure like this, right, you automatically should be keyed to what is going on, right? So even if you're right, is there a standardized formula for IV? The formula for calculating implied volatility, what exactly Brad's asking, is there a standardized formula for IV? What exactly are you asking for? Oh, call put ratio times open interest? No. Implied volatility is just the Black-Scholes model backed out to solve for volatility. Okay, so basically there's inputs to the model, right? There's stock price, strike price, cost of carry, time to expiration, and volatility, right? You put all those things together and it comes up with an option theoretical price. Okay. So if you don't know the volatility, you solve for it by just basically doing a little bit of calculus to the equation to solve for IV. Yes, exactly, Brad. So another question. So would buying puts be better option with the green upsloping sigma as to exposed to strategically positioning the spreads on the flat or red? So Teo K, he's asking, so yeah, that's what we'll talk about in the end. If the market's expecting a lot of movement, do you want to sell? Where do you want to sell options? Do you want to sell them near the money or out of the money? So we'll talk about it at the end. It's a good question. If that makes sense in terms of option, yeah, it will. We'll talk about at the end. But that's exactly the way to think about how you want what he's saying. What he's asking is the fact that the term structure says there's a lot of movement, does that change how you think about what options are? And absolutely. Basically, you think of it like this. If you see a green curve, do you want to walk into a buzzsaw by selling options that are right near the money? Think about it. You don't really want to do that, do you? So we're trying to capture the IV crush. Exactly. That's part of what we're going to be doing this about. Exactly. Dave's saying, so we're trying to write. This is a very leading indicator. Right? So the thing with looking at volatility is, I'm not here to tell you technical analysis is right or wrong. Anything like that. Any way you look at the market, I don't care. Okay? What I will tell you is that volatility is giving you a heads up on what everybody else is thinking because they're using their dollars to bet on it. Okay? And as a market maker, that was a pretty visceral thing for me. Right? You want to at least figure out what paper is doing or wants. And the easiest way that I always thought was just look at the term structure. And the best thing about the weeklies are, now all of a sudden you're getting a very granular week-to-week indicator. Right? You used to just get April, May, and 2 other months, right? You would have a stretched out term structure that was 9 months long. Now you get 6 strikes within 6 weeks. Don't you think that's a huge sea change in the way, right? Basically how sensitive the indicator is? I think it's huge. Okay, gives you a lot more information. Okay, so this is going to be our, I wonder if MB's tradings options, I don't know who MB is. Okay, so let's look at Amazon. Okay. Note, so now that we've had this little discussion, right? A crashing market could be green. Slowing market is red. So Dave is asking, is there any difference if it's a monthly expiring at the end of a week versus a weekly? Generally now, Dave, everything's sort of fixed in line. However, some weeklies are a little more, some monthlies are more liquid because they've been around a little longer. So what you might get is the monthly volatility might be a little better because it's a little more true because it's a little more liquid. Okay. So what you see in Amazon now is you strike the April 24 because the thing expiring this week, generally, again, if you're late in the cycle, doesn't matter very much. Okay. What I'm looking here now is you've got a little bit of edge here, or not, we'll discuss edge, but you have 1 month is slightly higher than the other. Okay. So if you have to draw this curve, okay, okay, kind of looks like this. Okay, you got a little upslope. Right, that's how that looks to me. So one thing that we're interested in, okay, especially in OptionPit, is when we try to find spreads, we want to buy an option that has a cheaper vol than the option we're selling whenever we can, right? Because I believe in volatility tends to revert, meaning it wants to go to a flat state. So if I'm buying the May 8s to sell the May 1s, weeklies, right, I want that part of the curve to go down a little bit. Right? So if I think that Amazon starts to slow down, right, it's not moving as much, the volatility in this term should start to slide a little bit and get closer to the volatility in the second term. Okay? If you have that expectation, and that expectation comes true, that's what should happen. Now let's contrast that, okay, with how the index looks right now. Here's the spot. Okay, what's the volatility in the May 1 term? Please explain at some point when you might use negative vol, meaning the front is lower than the back. You mean the picture right here, Eric? He's saying, please explain at some point when you might use negative vol, meaning the front is lower than the back. So what is this, right? You guys are seeing this term here. You've got a 987, 1026, 1059, 1055, 1064. right? This is basically saying we don't expect right now, the market is not expecting a whole lot of movement or less movement than we have right now. Doesn't mean it's going to happen, but that's what they're pricing. So from a realized vol point of view, the market is giving you a signal now that at least implied volatility or underlying volatility is going to be dropping in the near term, not rising. Okay. Amazon was a reflection of the stock just moved $50 on earnings. The S&P 500 has a reflection that we're not seeing a lot of volatility at all. So when Mark talks about butterflies today in course 2, right, you are looking at the idea of the fly is you want a little less volatility to make it work. If you have a downward sloping term structure, that should be a little less volatility coming in the future, which is more ideal for that type of trade. So the idea of our course, use some of the stuff you learned here, and that will help you when Mark talks in the second part. Okay, so a 37% drop in Sigma went into May 8 in Amazon compared to less than 1% in the SPY. So basically, yes, what happened was on Friday, right, you had earnings, volatility came out of the earnings on Friday for Amazon. So all the volatility, all the signals dropped hugely. Okay, on Friday here, you had volatility coming in very hard. This was mostly just because of the weekend coming. Right. So what liquidity providers do on the weekend is they run the value of their sheets forward in time, and it drops the implied volatility. Okay, and it will reset on Monday a little bit higher. But the key part here I just want to show you is in the market there exists, okay, different patterns for term structure for different products. Okay. If you want to trade the SPY, if you want to trade Amazon, if you want to trade time spreads, if you want to trade weekly time spreads, it should behoove you to understand how they work. If you just want to slap a time spread on and hope it works, I say I wish you luck. So the idea is you want to understand a little bit of how the term structure is going to play out. Right? So what I'm doing here is I'm setting the stage for how we want to look at putting on the Amazon time spread that we did, why I looked at it, and why it was even interesting for me to look at it in the first place. Okay, so we've just been here about 45 minutes. I know time kind of flies, but then we're going to go into putting that position together, managing the risk of the position, and just to cover the question that you asked earlier at the end, if you see higher realized vol, there's better positions in the weeklies than a time spread. Okay. All right. So with that, I'll give you 2 minutes. Saurabh, get another glass of wine. And now we'll go into a little more detail on just putting the position on, looking at the P&L, looking at the pricing. All right. I will restart in 2 minutes. Okay. Just a quick clarification. If IV is higher further out, it implies more movement in the future, but not direction. Correct. So he's asking if IV is higher out. Implied volatility now, the normal way of things is what you're seeing right here with the SPY. Meaning, not much is going on right now, so we're going to price volatility more expensive in the future. When you see contango like this, right, which we'll call contango, yes, I know, Howard. Mark, we've already spoken to him. Howard saying, yes, I know. I don't know what to say. It will be recorded, though. So all I'm saying here with volatility is this is the normal way of things. Okay. All right, so let's get onto our time spread. Okay, so what you want to do is you're trying to set up a position right now. At the beginning, we went through some things. We went through theta is something you collect, or vega is something that's going to cost you. Right? Vega is your sensitivity to a change in implied vol. Theta is the amount of decay you're expecting for the given position, meaning how much do you want, right? So you always have this kind of this trade-off when you're trying to build a position. Okay. What is my exposure to volatility, right? To a change in vol, and how much money am I going to collect every day if I sell something, right? That's theta. So Vega per contract is a bit smaller, but it is still meaningful. So what I'll say is this is what happens here. Vega, okay, when you have a position, okay, now I'm going to adjust. I've got the May 1 volatility adjustment and the May 2 volatility adjustment. So Vega sensitivity means overall my position is net long Vega, meaning if the volatility goes up 1 point total in both months, note how my P&L, I'm going to make about 50 bucks. Okay, but on a time spread, we actually don't want that, right? Optimal would be okay. If my front month volatility goes down 1 and my back month volatility goes up 1, notice this big swing in P&L. You guys see that? Just a 1 point move in vol. Boom. Okay. So Vega is a slightly smaller factor for a weekly because volatility is a little cheaper in the near term overall, meaning my 1 point of Vega, okay, is a little less. So if I go to toss, something like toss, okay, and we're just going to go, okay. If I look at what 1 point of volatility is worth in the May, let's say 445s, 1 point of volatility is worth basically $1. Okay. If I go to the May ordinaries, 1 point of volatility at the money, okay, is worth 44 bucks. Okay, that's 2 weeks out. It's a huge difference. Okay. You go farther out in time, 1 point of volatility costs much more money. So when you're dealing with the weeklies, okay, it's a little less because the term is so short. So a couple of things when you're putting on, remember that time spread does not want a tremendous amount of movement. That's the chart I showed you at the beginning. Okay, slower movement and declining IV are what you want for a short gamma position. Okay, you don't want a lot of movement, but you also think the volatility might come in a little bit. So there has to be a reason why the time spread might work for you. Okay, there has to be one more reason, right? Because slow movement, I just showed you that vol chart, right, of the term structure. If you're expecting IV to come down and you actually have a long Vega position and a time spread, you need one little more thing. Okay? Okay, so the reminder is your short gamma is the biggest risk with a weekly, meaning a move in the underlying will blow a weekly position out of the water faster than anything, especially if you sell contracts. Okay, so what we do is to control our short gamma, we push the terms together. Right. So the question earlier was, Andrew, how do you choose the strikes? How do you choose the terms? The closer you put the terms together, right, the less amount of risk you're going to have to underlying movement. Okay. If you spread the terms farther out, you're more exposed to underlying movement. So we go back to Amazon. Okay. We just had earnings. I was looking basically for kind of a one-day trade, right? Maybe two. Right? But it just had a big move. So there's no way I'm going to put on, you know, a time spread that has 2 months between strikes. I'm much more interested if I push those strikes closer, shut the gamma down. Okay? So what that does is it gives you basically, and when I say cheaper is better, it's giving you a cheaper time spread. So if you look at an example here, right, and let's reset our parameters. Right. If I, instead of the May 2, I buy something way out here like June 1 to make it, okay, notice my short gamma almost doubles. Right. But if you spread it out and can roll, you are better off. Eric's saying if you spread it out and roll, you are better off. However, okay, I want you to notice, you look at what my exposure is to Vega when I buy the June contract. Do you see what that is? Tell me what you see. Right? What's the Vega number when I go out to June? Right. Peter says 180. Okay. If I go to May 2, what's my Vega number? Okay. I'm way more exposed to a change in volatility, Eric, if I go out there. Right? So what you're doing is, by keeping the terms tight, I'm choosing my exposure to a change in vol. Right? Because the whole idea of this trade for my Amazon trade is I only want it for a day or two. If I go way out there and the vol drops a little more than I want, I might have bigger trouble. Right? And that's not something I want for like a 1 to 2 day time spread trade. Okay? So you can control this by pushing the strikes together. Right? Oops. So when I placed my weekly time spread, this was the idea, was $1.95. I forgot I had this other slide in here, but it's the same risk profile. I don't want to confuse you with the different slides. Right? It's theta drives the trade exactly, Saurabh, in your ability to collect it. Right? Because there'll be two pieces we'll see here. One is theta, how much can I make, versus, right, the risk I have to take in a change in volatility. Is there an ideal ratio? You're trying to collect basically as much theta you can. What I try to do, I'll set this up, Michael's asking, is there an ideal ratio? What I try to do is, you're trying to figure out where my Vega risk is, and I'll show you in a second here, versus how much theta I can collect to hit that number. Right? So if you look at your theta ratio, right, if you hold a position for 1 day and vol drops 1 point, you essentially wipe out your ability to collect the K, right? Because right here I'm showing 46 theta and a 50 Vega. So if vol drops just 1 point across the board, I'm making no money, right, from theta. Do you guys see how that is? So theta is your benefit from short gamma, okay, right? But there's no edge in it inherently, meaning, right, if I sell options, there's a cost. That cost is short gamma, okay? The only time I can really get something out of it that makes me interested, okay, is if my implied volatility relationship can change and I get accelerated decay. Okay, so if I can actually find a position, right, where I think my May 2 is not really going to go down, but my May 1 volatility is going to drop a point. Okay, all of a sudden, my quote-unquote decay profile does what? It accelerates, right? Because that front month dropped. So when you go back to that backward term structure, right, if you could just get it to come back to flat, that's how, or if it does come back to flat, that's how you're going to collect these dollars. Okay, so if you're putting on weekly time spreads, this is your expectation. This is what you need to win. If you can't get this, you're not going to win. Okay, that's the key part of a weekly time spread. Okay, so if you set it up, okay, you're looking at the shorter term implied volatility. So you start to get an idea now of some of the pricing of these things. Where can this IV go? What's the low? What's the high? Right? Because once you try to set up that Greek profile, what I'll call a Greek profile, the theta dollars for the Vega risk, You have to have some idea where that vol can go in the short term if it's going on the downside. Because remember, in your head, you're thinking, all right, I have a time spread. I don't want the underlying to move a lot. Okay? That's how those time spreads are successful. They need to stay in a range, right? It can go up a little. They can go down a little, depending on how you set it up, but it's definitely a range-bound trade. There's an adjustment we can make. We'll talk about that at the end. But there's a range there, okay? Anytime something ranges, generally you're expecting IV to come down a little bit. The key is, right, is that front month IV going to come down faster than the back month IV. So when you set up a time spread, that's why we're looking for slightly backward condition ahead of time. Right? And if you think about it, what's the most ideal thing you can have, right? So you set up something, okay, and the curve does this. You put it on, let's say, in this green thing, and what would really make you happy, right, if it did this, right? Because you're short this, long this. You get a small change here, but you get a big change here. Okay? That's how a weekly time spread becomes successful. Okay? Plus there will be a little delta there, which again we'll talk about, but that's kind of what you're looking for. So when I'm looking at Amazon, okay, Saurabh, the conditions that would make this happen is the stock just gets back to basically a normal, its normal pattern of volatility, meaning we just had earnings, you had a big gap. Now it's going to kind of do its normal $3, $4, $5 a day or whatever. And slowly what happens is the term structure goes, it collapses in the front. It does exactly what's happening with the SPY right now, right? So if you think about how's the S&P 500 been moving, right? That's kind of a visceral thing you could all feel now, right? It's not moving a lot. It's moving up. But anything it's doing is kind of what? Slow and dumpy, right? Do you guys remember the term structure picture I showed you of the SPY at the beginning, right? What did that look like? It looked like this. So Saurabh's asking, under what conditions will this happen? Yes, Dave, I know. We started at 9:30 Eastern Time. I don't have an answer for you. I did not set it up. We do have it recorded, though. Everybody email your invective to Mark. Okay, and all I can say is I apologize. But it is recorded, and he will make sure everybody gets the links. So when you're looking at Amazon, okay, and you're trying to set up some sort of implied volatility area, yeah, sorry, he's saying the time was messed up. Look at kind of the low for Amazon. Like the low for volatility is, let's say, 23 for the last 6 months, right? And in order for 30-day volatility, right, that's the red line is 30-day volatility. You can tell it was really high prior to earnings and now it came crashing down. 30-day volatility is essentially like the VIX. It's just the average volatility for a point 30 days in time, okay? So if you had to pick the sigma for 30-day vol, it would basically be right around somewhere between the May 4 and May 5 weekly. That's 27 days and 34 days. They're just taking that average number between the two. So you look right between the two, somewhere between 26.89 and 25.94. Okay. So what you're seeing here is when Amazon doesn't do anything, you see how basically the stock pattern is very flat. The implied volatility drops. Okay? It takes a while, though, to get there. The yellow line on the graph is the 180-day implied volatility, meaning that is the implied volatility 180 days out from now. So we're looking sometime in, what is that, 3 months from now is August to November, somewhere right around there. Right? Dave's saying reversion to the mean. Yeah. If Amazon stops moving, what happens to the implied vol? It will keep doing what? Going down. But the thing is, does it get, look at what happened after earnings, does it get to the low point right away? If you're looking at this chart just after earnings, how long did it take to get to the low point, right? It takes a while. Because you just had this huge move, and all of a sudden they're just not going to take the volatility to zero right away, right? It takes time. So when you're setting up a weekly time spread, right, you know there's going to be some drop in vol, but you know it's not going to the absolute low right away. It's just too hard for it to get down there. But you are getting an idea of the type of Vega risk you're going to incur. Because if you can kind of see what the absolute lows are, you can start to price it. Right? So if the volatility right now is around 26, and I know the absolute low is 23, okay? Now if we go back, okay, to here, what you're saying is I've got about 3 days of theta risk. So the absolute low for vol most likely is going to cost me 3 days of decay for at least that position. So you're trying to price this. Where is this chart in TOS? TOS doesn't have this detailed of implied vol chart, Dave. This is a live vol chart. But they do have an IV chart, which will definitely help you. It will give you the range, right? So if you go to here on TOS charts and you just look at implied volatility, okay, you need a 1 year, right? But it will give you an index number here. Right? So we're here, and the absolute low is there, right, for 30-day vol. Would you say there's a lot of implied vol risk there? There's not very much. So what you're trying to do when you set this up is, how much implied volatility risk am I taking? So I'll ask you an easy question. If the implied volatility is way up here, do you think a time spread is a very good position? You're right up here. No. Exactly. So part of understanding trading, right, using options positioning is it helps to know when the absolutely crappiest time in the world to put a position on is. You don't want a time spread here, right? Because the condition is awful for it. Okay? But maybe a weekly time spread you keep on for a couple of days where you're trying to catch that 4 vol to drop, okay, with relatively low risk. Now we're talking that's a better condition when implied volatility has already been destroyed. Okay. So what you're trying to do, right, is now you're trying to you're trying to balance risks. So when Mark does his butterfly class, right, it's the same idea. We're not teaching you one thing that you throw away and go another. Is right. You're trying to get a sense of the balance of risks you have to take. So I'm not going to say put on a time spread where you have extreme risk from implied volatility crushing your position. Okay? As you see in the top line there, there's not a lot of Vega risk in our time spread because liquidity providers have already balanced the market way, way, way down. They've taken that implied volatility down because they know as soon as you open, Amazon opened, what is everybody going to come and do with their positions? They're going to unwind them in size. Okay? But what there might be is some edge in the term structure. That's why I went through that at the beginning. Okay? The edge is going to be in the term structure. Okay, so that's why I covered that when I did at the beginning. Because now when we start to look at the position, and we can say, do we want to take, if we have to take that Vega risk to own some of it, is it worthwhile here? Can you catch the accelerated decay? You see what I mean? Okay. There's no way you're going to grab that accelerated decay by having that front month collapse if you get annihilated on the back month that you own. Can everybody see that connection I'm trying to make? That's the key part of this course. Any other time you put on a time spread like that, you're totally throwing your money away. Okay, so one of the key things is you want to buy cheap, and you want to buy cheap for while you have to hold the spread. Right? So what I'm trying to do is set up these times right around earnings, right? Before earnings, not a great trade. After earnings, possible, especially if you have a little directional bias. Okay? You know, and they are the talk that we were having on Friday morning is, you know, Amazon's just made this massive move. Is it really going to keep going? Which is why we put the spread just slightly out of the money. Does accelerated decay happen on all stocks after earning, or is it better on stocks that have gapped after earnings? Accelerated decay has the potential to happen when the term structure is backwards and folds down to, starts at the backward position, the green line, and moves to the red line. Right? So the easiest way for you to see, Dave, is, well, how is that term structure playing out when you put it on? Are those implied volatilities a little more expensive at the beginning or not? Okay, so put it this way. You can get accelerated decay. Accelerated decay happens when the front month volatility drops relative to the back. So you need it to be at least higher to start with, or at minimum flat to the back, and you need things to move to the red line. That's how that occurs. But after earnings is one of the ideal times because you still have some volatility left in those front month options. Remember, everything just doesn't come down all at once. It comes down a lot, but there's a little bit of residual. Okay. So by managing risk, what we're talking about is how much vega risk do I have to take? And what you do is you're trying to build some cushion. Does everybody like my pillow? Again, trying to think of images for you. So to answer Dave's question, right, my cushion here is what? If I can get that 1 point of volatility to drop, like in this example, right, it's 261 bucks. That's actually 5 volatility points. Right? That's huge. And there's no way the vol is going to drop 5 points. That would put you way through the floor of implied volatility. Okay, so the idea is your 46 bucks is basically, that will pay for your deltas going the wrong way, right? Because if I'm short a little delta with this position, this was the 340, it's just $5 out of the money. Okay, it will pay for my 3 points in the wrong direction. It'll help me there. Okay, it will also pay for a 1 point drop in volatility. So the more theta you can get for the amount of gamma you have to take, the better you're positioned. Are there better stocks to search for? The best stocks have slightly higher prices, Dave, which will give you better theta profiles. Slightly higher stocks with slightly higher volatility. Like Twitter after earnings will be a decent one. Apple, Facebook, okay, IBM. I think a lot of those right now. What you want to do is you want to take a look at the term structure and see how much you're going to get out of it. Right? The more stable the stock, the better this works. Okay. So what happened between the time I first looked at Amazon, okay, early in the morning to the close was this, right? We had a change in term structure. So here was our early term structure. I had around about a 1 point volatility difference, okay, between the two, 27.37 to 26.31. But by the end of the day, the May 8 weekly had stabilized. It actually went up slightly, and I had a little drop in the front. That's enough to start generating that accelerated theta profile. Right? Enough to try to close the position by the end of the day. So the idea is you want to find time spreads where this has the potential to happen if you want to trade the weekly time spread. This is a way to trade the weekly time spread that gives you a much better shot than normal. Do you prefer cheap options? So the idea is, what's the delta of the trade? If you trade a really out of the money option, Theo, he's asking, do you prefer the cheap options delta to remain below 20? What you want is the delta of the spread relative to the underlying, right? So a 5 lot in Amazon is 13 deltas, right? And the way Amazon moves, how many deltas do you want to take, right? Because you're trying to say, if I'm totally wrong on direction, I don't want my spread to get killed. I want to have the ability to adjust it. But I know if I can keep it on for a couple days, I'm going to make X dollars through decay. So if you buy a 20 delta, if you use 20 delta out of the money options, if you buy 20 delta puts, put spread, you're extremely short delta. If you buy a 20 delta call spread, you're extremely long delta. So if you have a delta opinion, you can play it out that way. All right, I got to hurry up a little bit here. Okay. So these are the things that should happen, right? As the front month IV starts to drop, the position should gain P&L. That's important. So if you were looking at a 1 point or 2 point drop, and you get that drop right away, you can close it. This could be real simply, this is a day trade. It can be a day trade if you get the move in volatility. Remember, all you're looking for is for that vol to change, the relationship to change. Once it changes, right, if there's enough dollars in it for you, then you can close it. If you do both out of the money put and call spread, MK, then he's asking, how about you do both? Then you have a double diagonal, right? And what we'll do is we'll look at that in a second, but that's certainly a way to do it, right? Because what you're trying to do. So what you're doing is, right, you're trying to take the delta out of the position totally by doing that. It is kind of neat. So when also Mark talks about flies, those are other types of positions you'll be able to, that are available to close in one day, depending on the type of fly you use. But again, another subject. Isn't it best to put the spread at the money with the weekly options? Not necessarily, Tim. He's asking, isn't it best to put the at the money with weekly? There's basically, you know, you read literature, the at the money decays the most, right? At the money options. That's kind of the Greek profile. But remember, out of the money options have a higher volatility, right? Because of skew, which I haven't even hit yet, and they're going to decay fast as well. So what we'll say here is, if you leave the position to the last minute, expiration day, you're going to have huge exposure, right? You could make an exception if you kind of drift down to the strike, but generally this is something you're looking to close early, right? Give yourself a volatility target with the term structure. If it hits, close it. Move on to the next thing. Okay. So setting these up. Right? You want to start with implied vol that is already a little lower, right? That's why post-earnings is a great time to start looking at some of these. Right? After a big move in an underlying in general, like IBM was just an example. Maybe you place, right, a time spread right under out of the money for that. Okay? Following a big crush in implied volatility in the indexes. Right? We use them, again, depending on, one of the best times for this is, you know, when they mark the VIX down sharply, start looking at the term structure profile in the weeklies in the SPX. Right? Because remember, if you get a little pop-up in volatility in the month you own, the positions do very well. Again, it's like anything. You're going to need practice. But at least what I'm trying to give you here is a starting point for how these things are going to perform. Okay? So instead of a backward term structure, gives you your best head start. So remember, okay, this green up here, let me start just so there's no confusion at all. Okay. Mark is telling me to hurry up. Okay. Green is backward. Okay. Red. This is contango. So there's no confusion at all. Okay. And then gray is flat. Okay. So my opinion of the weekly options and indices is my opinion of the weekly options. If the term structure, he's asking about the week. Michael's asking what's my opinion of the weeklies and the indices. If the term structure is right, yeah, then it's something. If they crush the volatility down, yeah, then it's something. But most of the time, it's nothing, at least for a weekly time spread. All right, remember, we're trying to focus on one thing. Okay. As soon as you start to move to contango, that's your signal things are going in the right direction. Okay. And kill it. All right. And when I say choose a spread that is giving the most room for the underlying movement, usually that means trying to stick those terms together as close as you can. Right? So, give me 1 second. Okay. So, right. So the nearer you go to the money, the less directional bias you have. Okay. You can set up with the delta if you want. That's what we talk. You just move it more out of the money. You basically stick a time spread where you want the underlying to go. That's the easiest rule I can give you. You stick a time spread where you want the underlying to go. Wes is asking, contango is higher IV further out like SPY? Yes. Right. This is the near term on the left. Near. Okay, far. Okay. What was your IV target when you put on the Amazon trade? I just wanted the front month to drop 1 point, Dave. The question on Friday morning was, I going to get the 1 point drop before Amazon moved higher, too much more higher. That was the thing that hung us on it, at least hung me on it. I felt the vol, we were going to get that, it was going to drift in a little more, but was it going to be enough? Was it going to happen fast enough before the stock kept going? But it turns out that it didn't. DD&F's earnings early on Friday and knocked out the put spreads. No one could predict this. The thing is, remember, these are after earnings. We are not interested prior to earnings. Okay? And also, let's look at a couple things here now. Okay? If there's no edge in the time spread, you might think to switch to a debit or a credit spread. Meaning, if you're going to use weeklies, right, and there's really no time spread edge, but you think there might be some IV pull, okay? Now, so all we're trying to do here, okay, question, is Mark going to talk about adjustment if we pick the wrong spot? We'll talk about adjustment in a second here, Eric. Okay. Right. So the implied volatility matters, like I said before, right? So because there is a vega component to the trade, okay? Different trades have slightly different shapes, meaning, and primarily, am I selling options to be a short gamma trade, or do I want a long gamma trade? So what we're trying to point out, especially with this slide, is, right, you want to manage the type of movement with the trade, right? You don't want to put too much in, okay? If you're putting on a short gamma trade, you have to have an expectation of lower realized vol. Okay? So, Mark, about 8 more minutes. Okay? So what the two things that matter, right, is, Mark, can you mute?
Oh, whoops, I didn't realize I was
Yep. Just give me 8 more minutes. I thought you wanted me to do like 1:45.
No, I do. I didn't mean to. I moved location, so I was making sure I was logged in.
Okay, yep, you are.
Yeah, no, I'm gonna start at 10:30.
Okay.
11:30.
Okay. Cool. Sorry, guys. So what we're trying to do here, right? You have lower implied vol or higher realized vol, right? Not a great thing for a time spread, right? You want to have some sort of slightly higher IB, meaning in our term structure, and you want to have the realized vol HV going down. Okay? You kind of want for a time spread the second piece. Right? So remember, we're always trying to sort of buy something cheap and sell something expensive. Could be in the term structure, could be realized vol versus implied vol. Okay? But the IV is still going to matter even when there's a little bit of time to go because those options move against each other. Okay? So one thing we asked earlier is if the realized volatility is very high, meaning you think it's high now and going higher, meaning the stock's moving a lot, selling weeklies is a very tough thing to do well. Any position that gets you short gamma with weeklies, you're almost always going to get snuffed out, right? So trades that you might use for the weeklies, think opposite. Think buying some type of weekly position, right? If the realized vol is super low, you consider selling weeklies, mostly, right, because you think things aren't going to move a lot, okay? Or they're not going to move a lot in the near term that they just have in the far term, right? So in my head, at least, I try to have a view of whatever the realized vol trend is, okay? And what that might mean is, do we sell some out of the money call spreads? Do we buy some, buy call spreads? Anything with the weeklies like this. So anytime I switch from like looking for a time spread type trade to a debit or a credit spread trade is basically just hinged on my view of what the underlying volatility is going to do. Okay? And here's just a picture of realized, here's one for Amazon, right? The white line is 10-day realized volatility, meaning right before earnings, it was down about 10%. Is there a reverse side of this trade to capture increasing IV going into earnings, or is it too dangerous? What I will do sometimes, Dave, is I will buy straddles in names where I think the implied volatility is mispriced. So I'll give you an example. The last 9 cycles, if you would have bought a straddle in Microsoft 3 weeks prior to earnings, it would have paid every time fantastically. Because it's usually made such a big move prior to earnings, you can unwind one side of the straddle and keep the other side for a huge credit 9 times in a row. So you have to, it's one of those things where it's not a layup by any stretch of the imagination to do it. And you need the same reasons, right? You need cheap implied volatility to do it. It's the only way it works. Once volatility gets into like the 60, 70% range, like in Amazon or something like, it's way too expensive. The options decay still too much. You just have to be dead lucky. You need cheap, right? So here is all realized volatility is you just had a big move on earnings. Is it going to really continue to move? Is it going to make a $50 move every day? Probably not. So the idea is, right, Amazon does a lot of movement after earnings, and after that it kind of settles down in general. That's our white line. But it's giving you an idea how much it can move versus what the options are costing you. Right? So realized volatility can get as low as about 15 in Amazon, but rarely. It usually averages around 18 or 19%. Okay? If we're looking here, right, there are periods of time, right, when the market was extra volatile where it was around 25%. So think of it this way. If you're selling volatility in a 19% implied volatility, but the realized vol is 25, if you're trading weeklies, right, you're actually selling implied vol cheaper than the realized is trading, you're going to have a hard time winning. Okay, if that pattern continues. Okay, so because the weeklies, right, are, if you sell premium in the weeklies, you have relatively explosive gamma, meaning if you get a big move in the weeklies, the position is not going to do very well. That's the biggest thing. That's why when I look at weekly time spreads, they're relatively tight, right? Unless I really want a delta, you have to figure out a way to kind of close down the risk, right? Or you kill the trade very fast if it goes past a certain point. Right? The good thing about the low gamma trade is the underlying moves a few dollars in the wrong direction, it's not costing you a ton of money. Okay? So that's why when I look at risk and a time spread, that's what I'm trying to figure out. How much can I make on the dollars that I have invested in this thing? Right? Time spreads are relatively decent returns if you're holding on to them for a couple of days. Okay. Couple rules about just credit and debit spreads with weeklies, how I think about it, right? If you're taking in a credit for something, you go as far away from the money as you can, okay, as we kind of segue out. If I'm buying debit spreads, I want to work as near to the money as I can. General rules. So if I'm going to sell spreads like the market's tanking and I want to use weeklies because I think some of these out-of-the-money puts are really expensive, I'll start to sell out-of-the-money spreads. Okay. But if I'm going to buy something, I want to do it as close to the money I can because I want the move, I want to win, and I want to close it. Okay, simple rules with debits and credit spreads. And the last thing I'll mention is there's skew everywhere. Okay, when you're looking at a debit or a credit spread, make sure you get something for what you're selling. Because of skew sometimes, right? And skew is basically just all it is it's an adjustment for some of the assumptions in the Black-Scholes model, meaning, right, the market tends to go down a lot faster than it goes up. Therefore, puts are a little bit more expensive in most equities. Okay, skew generally happens in the direction of demand, meaning, you know, people want puts when the market tanks. So they're generally going to be more expensive. So selling put spreads are never going to be there won't be any edge in selling the put spread strike to strike. The only place you might find it is selling relatively more expensive long. Right? So when I look at a picture of skew, now this is a data anomaly because it closed, you know, if the market moves after hours, I just took an after hour snap here. But if you note, right, as the strikes, the implied volatility here on the left goes up as the strikes get more out of the money. So as you sell put spreads more and more out of the money, they're giving you less and less dollars for every put spread because the volatility of one option is costing you more than the volatility of the next. Okay, it's just something to be aware of. So if you're going to sell short premium trades, even if you're going to sell call spreads over a time spread, right, you still need the same thing. You need the same realized vol outlook for what you want to do. To me, if I think the market, if the volatility in a stock is slowing down, is trending down, then I'm interested in selling options. But if I think it's trending up, I'm not. That is the basic thing I'm trying to say here, right? Credit and debit spreads want slightly different things, right? Debit spreads want some movement because you want to make the movement if it runs. A credit spread where you sell something out of the money, right? You just want things to die. So as soon as you start thinking about in terms of realized vol will help you with everything else you look at. Okay, so when I'm looking at these spreads, I try to give myself run wrong move, meaning a time spread, you can still be wrong about direction, right? If you look at this, right? If we're trading here, okay, and if we rally, I can still be wrong, but the position has a chance to be right. You're not getting killed right away, right? That's one of the best things about them, okay? You're giving yourself some room. If you sell a credit spread out of the money, it takes a while for you to get down to where you're selling it to. But what I will do is, in general, if it's a speculative trade where I'm just trying to sell short-term volatility, I don't want to lose more than half the credit I'm taking in. I either kill it or I'll roll it to a lower strike. Generally, I won't roll more than once. And the reason is I just don't want one spread to get out of hand. I would prefer to kill it, wait to see what happens, and then try to re-enter it another time. So I'll give myself a hard limit on these things. If I sell spreads, I'm giving myself a hard limit because you just don't want a whole slew of wrongness. Wait till you start being right about, let's say, a direction before you throw more on. Right? Because that way it keeps losses to one trade. Okay, so what I'll say here, to control our risk in a time spread, right, even in a weekly time spread, and that's what somebody just asked, if I add, let's say, if we start to rally and I add the 460 call spread, okay, all of a sudden what I've done is, you see how I've given myself a whole lot more room on the upside? Right, by adding a call spread, I can even reduce the size a little, okay, and add a call spread. I've given myself a lot more room on the upside. What I've done is I've taken some of the delta out, or I've added longer deltas by buying it. But you see how you've changed the profile shape by reducing the risk? So you just add the spread kind of in the direction where we're going and try to set it around one standard deviation out. Okay, one standard deviation, they're going to give you that number. It's right here on the right and toss. So what you do is you have one move. I've got my spread on. I still think there's some vol edge, but all of a sudden it's starting to move a little more than I want. I'll add an upside call spread, right, which will change my risk profile and give me more room to operate. Now I'm looking at 430 to 460. If I get my vol reversion, hold on. Okay, so this isn't a way to adjust this spread. Okay. Okay. And lastly, I think I probably have one or two too many slides here. All right. So names can gap on earning, but the realized volatility generally settles down afterward. So trades like this tend to work better after the cycle. Okay, not before. Okay. If you want to trade a credit spread, you can fade both the direction and the implied volatility at the same time. So I want to just compare something for you here. Okay. Now let's look at the return. If I can hold on to this trade, even if I have to adjust it, right, it's going to cost me around $600. This is $1,200. Everything works great. I make about $400, right? If I say I still want to fade this, but I want to sell a week 2 call spread, right? But instead I want to sell like the 460-65 call spread, let's say. Okay, and I sell a 6 lot, right? That's basically the same amount of money I can make. Now, the risk here, they're charging me $3,000 in margin, okay, for the trade. Here, okay, I'm all in for right around $1,200. So it's costing me about 1/3 the price of the margin on selling my spread, okay, to make the same dollars. Now the question is how manageable is my call spread versus my calendar? Right? I almost think I'd like to go a little, because remember this 460, where am I good to? Right? Actually break even up there. So when you compare the two, it's costing you 1/3 the dollars to make a similar return as if you just sold a call spread, right? When you compare a calendar, even with an adjustment, to just the risk of just selling that out of the money call spread in here, right? It's hard to have a move with this one, right? What's your move if things rally? Right? My move would be to reduce if it's going the wrong way. Okay, that would be my move. That's all you really can do when you sell a call spread. At least when you use these shorter term calendars, you've got a little bit more flexibility on making an adjustment. Things pop up and they come back. right? And they're costing you slightly less dollars. So what I would just say is, if the conditions are right, sometimes those calendars or the time spreads will look a little better than selling out of the money call spreads that you're just trying to grab that implied volatility drop. Okay? So you want, when you're looking at trades, think about the dollars it's going to cost you versus really what you're going to get out of them. Okay? So as we finish, right? So it's just a way to compare similar dollars and the risk and the ability that you have actually to adjust a little bit and still have a good chance to make money. And so as far as closing them, right, don't fall in love with the P&L. Oh, I'm making money, I'm making money, I'm making money. Close them. You want to set reasonable targets for positions, meeting your vol expectation going down. Right? So be like Alec Baldwin and always be closing the positions. Okay? You can roll the short if it's okay, meaning if you're long, you can roll your short collapses and you have a chance to sell another contract and things are going okay. There's nothing wrong with rolling it and trying to keep the winner going if you use, basically get a little bit more time going. All right? But this is the profile, right? You need to get your story from the term structure first. See what the market's trying to tell you. Get a picture from realized vol. Do you have an opinion? Right? Because you're trying to match the two. You're looking for sort of an impedance difference. Right? My God, is that term structure going to stay like that and come in, which would make a nice time spread? Or if I still think the volatility is coming in, could I sell a credit spread and make enough money out of the money? Okay, so you look at what your risk for Vega is by using kind of the lows and the implied volatility, and you can actually gauge how much your risk is. You only have like 1 or 2 vol points. Okay. Okay. Finally, once you put it on, just like we did with the time spread versus a credit spread, how does my risk-reward ratio look, and am I picking the best one for the dollar? Okay. Have your routine established as adjustments. I get to this point, I adjust. Normally, I won't adjust the time spread until I'm starting to move out of the tent. Right? So the example here for Amazon would be, if I've got I'm here, I'm not really going to adjust until I'm kind of out here somewhere. Going under the thought of, as I decay, don't forget, time is still going on my side every day. Right? And, if you pull back, you get into the tent, you're okay. I'm not adjusting until it really looks like I'm totally wrong on the direction. So I tend to put them just out of the money to fade a move. Remember, you put the time spread where you think the underlying is going to end up. That's where you set your range. It's the easiest way I can describe it. Okay? And because it's a weekly, you take profits because a change in direction, remember, because the gamma is so fierce for a weekly trade, take your profits and move on. All right? Okay, so what Mark's going to teach you, right? He'll go into weekly options, use of flies, the wheel, and the weekly wheel. 2-week, 3-week versus 1-week, 2-week calendars. I would say some of my favorite ones are the 1 to 2 week. So basically, MK, I'm looking at next week's 1 to 2 week calendars. Generally, that front week is the one that has the most potential to drop. So the sample is, I'm on like a Friday, I'm looking at the May 1, May 8 for like a one-day trade. The 2 to 3 could be interesting if you really have nice backwardation in the term. Okay, does that answer? He's asking, is 2 to 3 week better or 1 to 2 week? You'll get the most action out of the 1 week versus the week 2, the week prior to putting it on. So once you're in the term, like next week on a Wednesday, I would say is not a great time to sell the 1 weekly. You want it with a little time left, at least a week to go to expiration. Okay, and if you're looking for a trade that's a day trade, you're looking for that 1 to 2 week, right? Because if you're only in it for a short amount of time, you want the term to kind of mirror how long you think you're going to stay in it, right? 2 to 3 week calendar, if you're looking at that type of term structure, you're looking for about a week hold, at least, right? If you go to the 1 to 2 week calendar, it's only like a couple of days. Does that make sense? So you're just trying to match the term for how long you think you even might want to stay in it. for that reversion to take place, for the term structure to flatten out. Okay? This is what Mark will teach you. I heard that one can win 3 credits and then lose on the 4th and end up breaking even. Well, that's the whole point, Doug, is you want to manage any credit risk. That's why I don't want one trade to eat up more than one other. Okay? Right. And if you think about trading like that, you say, if it gets to this point, I'm going to lose, right? If you keep a loss to a little tiny bit and stick with it, right? But just if you're let's put it this way, if you're trading 1 lot or 2 lots, you say, if I'm down $40 on this, I'm closing, try to do that. Most of the time, like, oh, it'll come back, it'll come back, it'll come back. Instead of saying, oh, I'm just going to kill it fast. I'm wrong. Remember, if you're trading an out-of-the-money credit spread, it has a low delta, and if you're down that much money, you are way wrong on direction. That's why you want to keep that relatively tight. Okay? Questions? If you have them, email me, andrew@optionpit.com or mark@optionpit.com. And I thank you all very much. Mark will be on in about 10 minutes. You will get the decks and a link from Mark. All right? Any other questions before I go? I got some thanks, so that's good. Hopefully you learned something new. And some of you I'll see next week at OptionPit. Some of you I see a lot of new names. Howard, it should go up by tonight. Oh, thanks, Greg. And remember, if you have questions about anything, you can always email us, especially time schedule, if anything looks a little goofy. All right, everybody. Yeah, so the deck will be available. Yeah, you guys, I have to, basically the same link that you used to get into mine, you can use to get into Mark's. It's going to be the same link. Yep. Or you can just leave it on. But I have to stop my recording because I got to process the video. So when you get the links, you're going to have 2 separate, you're going to have the same go-to webinar link you used to get into this one, you'll use to get into Mark's. But you will have 2 separate recordings.
What you'll see is under My Courses, when you log in, it'll be there permanently. So you'll be able to, if you go to the website and you click under My Courses, what you see is your course is there.